Establishing the viability of a business venture comes down to determining whether you can make more money than you spend. There are a number of tools and financial documents that can help you to figure this out. However, it's important to note that many of the numbers that make up these documents are estimates. So the more research and information you get, the more accurate these estimates will be. The more accurate these estimates are, the greater the likelihood of you making good decisions and being successful. On completion of this unit, you should be able to identify and explain the purpose of the common financial documents related to starting a business, as well as be able to utilize key tools that will help you with your financial forecasting. Let's review the 3 documents that are commonly seen and often asked for in a typical business plan. Those are the balance sheet, the income statement, and the cash flow statement. In addition, we will review the fishbone diagram. While the fishbone diagram is not a classical tool, it helps identify the cause and effect relationship that exists in every system. The first document we'll look at is one that shows your overall financial health, the balance sheet. It is often asked for if you're trying to secure a loan. The balance sheet is a snapshot in time and includes 3 major sections: assets, liabilities, and equity. Assets include all of the money and other tangible things in the company, things like cash, the value of inventory, supplies, and equipment. Everything in the company comes from 1 or 2 sources: liabilities and equity. Liabilities include loans and accounts still to be paid, or payables. Equity includes the personal money the owner puts into the business to pay for assets and the investment obtained from external investors in the form of angel investment or venture capital. More on this later. The balance sheet should always balance. Everything worth something in the company is equal to where it came from. If you haven't started your business yet, these numbers may not be much more than 0. The document becomes more important over time as you build up assets, liabilities, and equity. If you are looking for a loan to start up your business, the bank will be very interested in your personal balance sheet. Over time, you'll become more and more interested in your business balance sheet, looking very closely for changes over time or issues related to too much debt related to your equity or other details known as financial ratios. Let's look at an example. If you account for everything that this company has in a way of assets, you'll notice that there is $50 in cash, $80 worth of accounts owned to the business from customers, inventory that is valued at $220, and $500 worth of equipment for a total of $850. This $850 in value has to come from somewhere. Either it is money that is owed to others, or it's owned by the owner or owners. In this example, the company owes $20 to their suppliers, has a $300 loan outstanding, and the owner owns $530 of the value of the assets in the business. As you can see, the total amount owing to others, $320, and the amount the owner owns, $530, equals $850, the same amount as the total of all the assets in the company. Income statement. The income statement is a financial report that shows how your business has done over a period of time, usually a year. It shows how much money you have made during this time frame and is essential to help you understand if you are profitable or not. The income statement starts with your revenue or sales, then lists in detail all the expenses required to run the business over a specific period of time, often a year. A simple calculation of total revenue minus total expenses will help you determine if you've made or lost money over a period of time that you are accounting for. For a startup pre-launch, this will be an estimated document and will help the entrepreneur and potential investors to see what the business profitability looks like, or at least what it is anticipated to look like. For an existing business, it will become imperative to produce income statements for the purpose of determining your business taxes and overall profitability. As with the balance sheet, it will start out as an estimate with anticipated values, but eventually becomes real once your revenues and expenses are known. Let's look at an example of an income statement. First, Let's assume that the firm generates $40,000 in revenues and the cost of those goods were $20,000. In this case, we have a number that we refer to as the gross profit of $20,000. Now let's assume that the cost of marketing was $2,000 and suppliers were an additional $2,000 for a total operating expense of $4,000. This leaves us with $16,000 of what is referred to as operating income. Assuming the company pays business income tax at the rate of 25%, the income tax owed is another $4,000, leaving the business with $12,000 of after-tax profit. Of course, this document is critical to help you determine if the business is making money or not. Cash flow statement. The cash flow statement is probably the most important financial document for an early-stage company. Similar to the income statement, the cash flow statement lists in detail all the sources of expenses and revenue, but also includes other sources of money coming into your business bank account. Essentially, this document is an estimate of money coming into your bank account and money going out of your bank account when you anticipate it happening. So it becomes an important planning tool that will help guide strategic decisions. It should be done on a month-by-month basis and be completed for at least 1 year. It should also be seen as a living document that gets updated as actual numbers become known. Sources of money coming into your bank account should include a healthy amount of anticipated sales revenue, but will also likely include your own personal investment, perhaps other equity investment in the company, or other sources of money, such as loans or government programs. Money going out of your bank account will include all the expenses that you anticipate incurring month to month. The statement looks for an estimate in these in and out estimates to appear when they will either go into or out of your account each month. For instance, if you sell a service in May but anticipate only being paid in June, this amount will appear in June when you anticipate it will actually be going into your bank account. As well, if you will take the receipt of supplies in June but don't anticipate money coming out of your bank account to pay for them until a month later, then the cash flow statement would show the outgoing amount in the July column. As you can see, it also becomes an estimate of your bank account balance at the end of each month. The estimated cash flow statement becomes a great planning tool to see if your bank account balance is estimated to get close to, at, or below zero, in this example in month 4. Of course, if this is what your initial estimate reveals, you may have a big potential problem, and you can start making adjustments to money in and out now before it's too late. Many great businesses have gone out of business due to poor financial management. They weren't prepared for some negative cash months and simply didn't have the financial resources to cover these difficult times. Had they anticipated these issues, they could have looked at bringing in more of their own or others' money, or looked to defer expenses until such a time that they had the cash. In this example, I'd be tempted to bring more of my own money into the business to begin with, or look to defer some of the month 1 to 4 expenses, if possible to better cash months. While this is an estimated or anticipated statement, you can start putting in real numbers as soon as you start realizing real revenues and expenses. This may cause you to redo the statement many times throughout the year as your actual numbers become known. It will become a document that you will find yourself using very regularly and will help you make educated decisions about your business on an ongoing basis. A fishbone diagram helps identify the cause and effect relationship that exists in every system. The head of the fishbone diagram is the effect. The bones in the fishbone diagram are the generic causes behind every effect. You can apply the fishbone diagram to a company's profits. In this case, the head is the profits, and the bones would be the cause of this profit. As we all know, the cause of the profit is the revenues and costs, but what are the drivers of each? The fishbone model helps examine the various assumptions and enables the understanding of the riskiest assumptions as well as the one with the biggest leverage. Start with drawing the key drivers of revenue and costs. Then identify drivers and assumptions behind the key drivers. Once that is done, test sensitivity to changes in drivers and analyze how reasonable key assumptions are. This tool would help to surface key assumptions, logical inconsistencies, critical sources of uncertainty, and important questions to ask.